Good afternoon, everybody, and welcome to our second quarter market update. My name is Lorenzo Pederzani. I'm one of the two portfolio managers on the Westmount Wealth team. I'm joined by Matthew Evans, who's one of the other portfolio managers on the team. Today, we're going to talk about what happened in the markets and talk a little bit about what happened in our portfolio over the next 20 minutes. Obviously, it's been a very eventful quarter, so we're hoping to provide a little bit of context for all of our clients. We always start off each presentation with a bit of a quote, and we thought the most fitting quote for today was one from H.P. Lovecraft, who said, "The oldest and strongest emotion of mankind is fear, and the oldest and strongest kind of fear is fear of the unknown." And I think that's quite apt to what we're seeing in the markets today. So a quick disclaimer to get started here today. Everything you see and hear was prepared by Matt and I, who are portfolio managers at Westmount Wealth. We believe that all the information here is reliable and accurate to the best of our ability. A lot of the information is based on the analysis interpretation that we're doing, and it may change down the road, and we have no intention at this point of updating this publication. You may hear us use words throughout the presentation where we're looking forward in the future, saying things like might happen or could happen. These are what's called forward-looking statements, and they're not predictors of what's going to happen, obviously. Opinions that we express do not constitute any form of solicitation, and we talk a little bit about alternative investments in the presentations today. It's important to understand that alternative investments are not suitable for all investors. And lastly, Westmount Wealth Management is a registered portfolio manager in BC, Alberta, and Ontario. So let's get things started. Matt, can you start off by telling us a little bit about what happened this quarter in the markets?
Well, it was a very eventful quarter, but we've listed four of the main reasons for some of the volatility we saw. So a lot of these reasons were the same reasons in Q1 of our review. So high and rising inflation, so cost of goods going up. We've got an ongoing war in Ukraine. And to combat that rising inflation, we've got monetary tightening, which is just a fancy way to say that we will have interest rates moving higher and money supply being constricted. So all of that is leading to recession concerns, which has created a lot of that volatility in both stock and bond markets. So the biggest culprit here is inflation. So what we're showing in this chart below, squiggly blue line, is the headline CPI, which is tracking a basket of goods. So we're looking at it year over year, and last month it hit a number of 9.1. So just to kind of explain what that means, if you had a $100 basket of goods, this year it is now $109. So the cost of goods is going up, and to help stop that, central banks around the world, so that's Canada and the US, are using monetary policy to help bring inflation down. So the real question here is, have we reached peak inflation? And if we have, central banks won't need to raise rates as aggressively as they've been forecasting. So that's what we're showing on this slide here. We've got the short-term federal fund rate, and this is one of the tools that central banks utilize to slow the economy. So to actually contract the economy and potentially push it into recession. So the solid line is showing where interest rates were in 2020, so incredibly low. As we came out of COVID, interest rates started to move up, and that's to bring that inflation number back down. So the dotted line is showing where we could potentially go with rates. And as you can see here, the Fed is kind of indicating a terminal rate or a final rate somewhere around 3.8. What's interesting about looking at this, though, is the dotted green line, and that's what the market is actually expecting. So the market is expecting the Fed to not get that high, not increase rates that much, but get to a rate of about 3.4 to 3.5. And then at that point, we may have an economy where we need to stimulate it by cutting rates, and that's why you're seeing that dotted line trend down. So in the short term, rates will probably move higher to bring down inflation, and that could be a move too far where we might actually have to cut in 2023, yet to be seen.
So, to summarize, we've obviously seen a sharp increase in interest rates so far this year, both in Canada and the US. But in both bond markets, in Canada and the United States, the market is anticipating that we probably have another percent or more to go in terms of rising rates. So Matt, why don't you give us a high-level view of how each of the two major categories of asset classes performed?
So the first we're going to talk about are bond markets. And as you've heard us say before, typically when you've got a rising rate environment, that's putting downward pressure on the price of bonds. So no surprise here, you can see from the Canadian bond universe to the US bond universe to the global bond universe, all down quite substantially. So if you're thinking about your typical balanced portfolio, a portion to bonds and a portion to stocks, that more conservative side historically is really feeling the pressure as rates move higher.
And I would want to add to that, this is a very significant move for bonds. As you'll see in the next slide, we're seeing the equity markets down, double digits. That's not an unusual occurrence over a decade, but the bond returns that we're seeing in Canada, the US, are the worst returns we've seen for the first half of any year that we've seen in over 40 years. So it's a very dramatic and unusual period of time for the bond markets. And traditionally, we hope that bonds in a portfolio act as a bit of a counterweight. They're kind of, you can think of them as portfolio insurance in a way. When the stock markets are doing badly and people are worried about owning stocks, they sell their stocks and they buy bonds, and that pushes up the price of bonds. And so the traditional balanced portfolio, let's say, would, the bond component would act as a counterweight. Unfortunately, we're seeing a situation where not only are the bond markets being, very severely hurt right now, but obviously the stock markets are as well. So you're seeing, in Canada probably the best performing of, one of the best performing of the developed market stock indexes, down only about 9%. Obviously a lot of commodity exposure in Canada, and with the war on the Ukraine and global supply chain disruptions, that has really helped, the Canadian market, let's say, outperform relative to S&P 500, which as of the end of June, down, 18.5%. And more dramatically, even the more kind of growth or tech stock oriented NASDAQ index down almost 30% on the year, and globally about 17-18%. So it's been a very dramatic start to the year for both stocks and bonds.
The real question here is, has the stock market priced in a potential recession? And that's kind of what we're going to go into.
Go.
So Lorenzo, most of our clients want to know, how long do you think this potential recession or down market could last?
Well, obviously, we don't have a crystal ball, but the best that we can do is go to history to give us a sense of how things have performed in the past. And so when we take a look, for example, at the U.S. National Bureau of Economic Research, which, for a long time has measured U.S. expansions and recessions, we see that on average expansions last about 4 years and contractions last just over a year. So you can think of the economic cycle on average as being 5 years in length, with 4 years on the up and 1 year on the down. Another way of looking at this data is looking at U.S. consumer sentiment. Now again, we're looking at the U.S. because U.S. is still the largest economy in the world, and what happens in the U.S. still has a great effect on global markets, especially for Canadians that are so closely linked economically to the U.S. But this is data from 1971 until present, so 50 years of data looking at how consumer sentiment, or how optimistic or pessimistic, let's say, American consumers are feeling about the economy. And what we see here from the graph is that there's been, I guess, 9 at this point low points in consumer sentiment since 1971. And if you take a look at the first one there, essentially that green dot at the bottom, that consumer low point hit on February 1975. If you take a look there at the next 12, the return of the S&P 500 in the next 12 months, the S&P 500 returned 22% going forwards from that low point. And again, if you move forward along and look at those blue dots on the bottom of the graph, you'll see that on average, you've got a range from anywhere from 14% all the way up to 43% in April 2020, where in the next 12 months, the stock market in the U.S. did actually very well. So right now, we're actually sitting at the lowest point in consumer sentiment in over 50 years. And that, to me, is actually quite surprising, because you think back to the great financial crisis of 2008, we're seeing consumer sentiment now that is even more pessimistic than that. So Have we hit the bottom? Obviously, we don't know, but we are certainly at a low point at 50 years, which should mean that once things turn around, we should see a good rebound, hopefully, in the stock market.
I think that's the right point, Lorenzo. It's really a contrarian indicator where people are so pessimistic. Chances are we may be looking at a recovery at some point moving forward.
Perfect, absolutely. The other way to look at the data is just to look at intra-year declines. And this is a slide that we brought out in the past to clients, and I think we did add it into a presentation a few months ago. But I think it's an important thing to understand is that stock market volatility is a normal part of being an investor. If you take a look here, we're showing data from 1980 until present. So it's 42 years of data. The gray bar that you see on the screen is the calendar year return of the S&P 500. So you can see that 32 out of 42 years, just over 75% of calendar years, the S&P 500 created a positive result in the markets. However, the red negative numbers underneath at the bottom of the graph show the peak to trough drop in the S&P 500 within that calendar year. So on average, we've seen that even though the S&P 500 in this 42-year period of time has returned a 9.4% return, the average intra-year drop has been 14%. So seeing an average of a 14% drop from peak to drop within a calendar year is a very normal part of investing. And like everything with investing, the closer you look in, the more volatility you see, the further out you get, the smoother the line gets. And it's always important to remind ourselves as an investor that we need to take more of a long view.
And I think really the point here is 75% of the time, or 32 of the 42 years, we finished positive. And that's really why we are long-term investors in the stock market. You just need to hold it long enough to see that return set.
So Matt, could you give us a sense of what, as a firm, we're doing to help protect clients during this market downturn?
I think that's a good question to ask because we've had quite a few clients ask us what we are doing in our models in response to the current volatility. And one thing that I've been saying is it's not what we are doing, it's what we've always done. So there are 7 key parts to our investment philosophy. And the number one, and one of the most important, is staying invested. We know that it's more important to be invested in the market than trying to time the market, because timing the market is a fool's game. No one can do it successfully. Second, we need to remain broadly diversified. So that means holding assets, including cash, bonds, stocks, and alternative or private assets. We know that we'll go through periods where some asset classes won't perform, like right now, where we've got stocks and bonds moving down. We need other asset classes to help offset some of that performance. So that's being broadly diversified. Holding investments that pay an income is also very important to us. Most of the clients that we manage are taking an income from their investments, and we need their investments to pay them an income. So just like a rental property, you want to receive compensation for holding that property as it may stay level in price. Number 4, holding high quality bonds as portfolio insurance. This just means holding more investment grade or government bonds so that when the economy does go into a recession, typically that's an asset class that does quite well. So if we go into recession, that's the part of the portfolio that should be moving up. Number 5, utilizing a cash wedge for retirement income needs. Like I said, most of our clients are taking an income, and it would be foolish for us to go into the market and sell an asset every month to pay their withdrawal. So instead, what we're doing is we proactively set aside 1.5 years worth of their income need, and we hold it in a high interest savings account. That high interest savings account then is depleted over the months, and the yield, or that income from the portfolio, will help replenish that wedge so that we do not need to sell a falling asset for at least 3 to 4 years. So that allows you to ride out a poor market cycle. Number 6, holding US assets in US dollars. So the US dollar being the global reserve currency typically gets a bid, or it goes up in value during times of crisis. So right now we're seeing the US dollar rally. And as Canadians holding US assets, we want exposure to that US dollar so it can help offset some of the losses we're seeing on the US stock markets. And then finally, enabling our clients to diversify into a wide range of alternative asset classes. This is a very important tenet of what we do. And in an example, we're going to go through a little later on, but it allows the clients to access parts of the investment universe that aren't represented in the stock market, like student housing, industrial warehouses, items like that. So it's just another form of return that we can get from the portfolio.
And that leads us into a bit of a look on one of the funds that we launched. So Matt mentioned in the last slide that, for many of our clients, we're suitable. We invest them in alternative asset classes. Now, alternative assets for private investments, it's really just a blanket term. There's so many different categories of alternative private assets, and we've effectively at this point bundled them into 3 buckets for clients. One bucket we call alternative income, and that includes things like long-short fixed income, which we have in the fund. It includes lending to private companies, which is known as private credit. It includes structured notes, which many of you are familiar with, where we're taking certain derivatives and we're changing return features on investments for a more structured payout. And includes mortgage investment corporations, both residential and commercial. And you can see here the current breakdown as of June 30th on the alternative income fund. We're not allowed to report performance data at this point on the fund because we need a 1-year track record, and we launched the funds last December. But obviously, if you look at your statements, you'll be able to see the performance, of the investments. Wanted to provide a little bit of a peek through at this point of some of the holdings. One of the things that we hold in the funds at this point are 9 structured notes. So if you own the Westmount Alternative Income Fund, as part of your portfolio breakdown with us, right now you're holding 9 structured notes. Now, if those structured notes all pay out with all the coupons and are all called within a 12-month period of time, again, that's not a guaranteed, we have the potential of a blended yield of about 8.7% effectively as an income stream, from those notes. So they're providing a different form of income, if you will, to investors. The other thing we're doing is we're lending to private companies. These are generally what's called kind of small to medium market companies, generally valued from about $100 million to $2.5 billion. And the industry landscape in the banking world has changed quite dramatically in the last 10 to 15 years because of different accounting and regulatory rules, where a lot of banks that traditionally used to lend to small to mid-sized companies are less keen to do so. And so the lending for that space has become much more privatized. And it doesn't traditionally go to bank channels in the way it did before. And so the opportunity is for us to invest in funds that lend to companies like that, just to diversify the income stream. The other thing that we have right now is commercial development loans. So right now we're lending to 54 commercial developments across Canada and the US. And through 2 of our holdings, Intra-year Mortgage Fund, many of you will be familiar with it, and Neighborhood Holdings, which is one of the newer positions that we added to the fund this year. We lend out to about 3,000 residential mortgages across Canada, so quite well diversified there. Matt, do you want to take us a little bit through some of the holdings of the Westmount Real Asset Fund?
So if we look at the high-level asset allocation of the real asset fund, currently it has a 40% exposure to infrastructure assets and 56% exposure to real estate. So when we take a closer look at what we're actually holding, we're just going to highlight some of the holdings in the funds. You have exposure to 34 apartment properties in the state of Washington and Oregon. What's interesting about that investment is that we are owning the apartments in a non-rent controlled market, which allows for a higher rental yield. So as an investor in those properties, as owners of those buildings, we collect a higher rent than we could in a rent controlled market. We've also got 5 properties across Canada in that multifamily apartment category. Moving along, we've got 11 student housing buildings. So we are leasing out these complexes to students, and they get fully leased up every September. So it's a nice way to diversify from residential real estate, like we spoke about prior, to something a little more niche, where there's quite a bit of demand for student housing and a lack of supply. And then one of the main drivers in the portfolio for the Westmount Real Asset Fund has been the industrial property exposure. So there are 34 industrial warehouses located in BC, Alberta, and Ontario. And that really drove a lot of the performance. And that's because there's a lack of these properties close to city centers, and we are all using more same day delivery. So think about your Amazon Prime, where you expect to get the package the next day. You need a fulfillment center or an industrial property to deliver that good. So we've got a lack of industrial space, and therefore owning the buildings has worked out quite well as an investment. We then now look at, continuing along with real estate here, we've got 15 office towers, again, across Canada, 7 retail properties. When we're talking about retail, one of the largest tenants is Shoppers Drug Mart and Superstore. So very key tenants where we don't need to really worry about the business risk. And then we've got exposure to about 26 real estate development properties in the state of Texas, Georgia, and Arizona. So a little more looking for more of a growth-oriented exposure on the development side. If we take a look at the infrastructure side, quite interesting when we take a look at the assets that we're owning. So the way that an infrastructure asset works is we own the asset, and that asset produces something. In this case, a wind farm would produce energy, and that energy would be sold to a municipality to help their energy grid. The nice thing about those contracts are they're typically inflation adjusted. So as inflation moves higher, we are retaining our purchasing power on a contract like that. So we've got a wind farm in Texas. We've got solar farms globally, US, India, Chile, Portugal, Spain, and Poland. We've got exposure to a fiber optic cable network in the UK. And of course, the cell phone towers we have ownership of in the United States that we spoke about in a previous webinar. So just another way to help diversify our clients' portfolios.
And some of these are very large holdings. Just to provide a little bit of context, I remember when I first read in the Mackenzie Northleaf private infrastructure funds information holdings about the solar farms, I didn't really understand what 923 megawatts meant. And I'm sure for many of you, that is not really necessarily a measure that makes sense, but effectively, you know, they estimate that that's enough power to support about 1.3 million homes for a year. So it's a very significant amount of, you know, solar infrastructure that we have in there as well. So again, you know, the reason we like infrastructure often as an asset class is they're projects which cost a lot of money up front to get going, but then once they're running, you get a very nice steady stream of cash flow. And many of the contracts that you have with solar or with wind farms are with municipal or government authorities, so good payers, where you have, you know, reliability of cash flows over time, which helps smooth out returns for investors. The other position that we're considering, you know, this is not currently in the real asset fund, but we have made a commitment with Manulife through Hancock to purchase a holding is Farmland and Timberland. Again, we're trying to provide clients as much diversification as possible. So the real asset fund will include not just real estate and infrastructure, but going forward also farmland and timberland holdings globally, where we have timberland holdings in the US, Australia, and Brazil, permanent crops and row crops in the US. So different types of investments that have kind of a smoother, often steadier return patterns. And the last of the 3 buckets that I mentioned that we've kind of categorized or broken down alternative investments into is private equity. So some of you in our core and our growth model will have a weight to Kensington's private equity fund. Here, again, you're owning private companies, so not publicly traded companies. Within the, you know, we were reading a report the other day that UBS Bank put out, and what they were showing was breaking down among the global ultra wealthy, the percentage of alternative assets that they hold, and kind of what the buckets are. This is probably the largest bucket for most ultra wealthy individuals in terms of a weight. They hold in the alternative asset space, they hold the most to private equity. This fund structure has been a very attractive one for our clients for a number of reasons, and again, it continues to help diversify clients. In a market where, in a year where traditional equity markets are down quite substantially, as Matt walked us through, a few slides ago, this fund is up almost 6% year to date. So again, helping to diversify, and protect clients across the board. That's it for today's presentation. Thanks so much for joining us. We would love to answer any questions or emails you might have. Just a quick final disclaimer. We mentioned that interest rates are going up, and some investments that we hold might see higher yields as a result. Of course, that doesn't mean that those returns will exceed expected inflation. That's it for today. We'll see you next quarter. Cheers.